All facts in this video come from publicly available sources, with references included for transparency. Around 3 weeks ago, something major happened, yet almost nobody noticed. In a routine SEC filing released on a quiet Friday afternoon, Goldman Sachs revealed it had slashed its U.S. Treasury bond holdings by hundreds of billions of dollars in only a few months. This wasn't simple rebalancing. It was a strategic move away from what's considered the safest asset in the global system. U.S. Treasury bonds are the backbone of world finance, trusted by governments, banks, and investors. But Goldman's massive selling sends a different message. And they aren't alone. Over the past 18 months, large financial institutions have dumped more than $847 billion in U.S. government debt. That amount is bigger than Switzerland's entire economy and nearly 3 times the U.S. military budget. While headlines claim inflation is controlled and the economy is stable, smart money appears to be positioning for something else. Bond prices fall when interest rates rise, meaning older, low-yield bonds lose value as new, higher-yield bonds enter the market. When institutions sell at this scale, it's rarely random. It's usually a signal that risk is building beneath the surface, and the people closest to the data are quietly preparing for what may come next. If you hold a government bond until maturity, you eventually get your full principal back. A $1,000 bond pays you $1,000 when it matures. But if you need to sell it before that, the price depends on interest rates. When rates rise, older bonds with lower yields lose value. Now, imagine a bank holding hundreds of billions in bonds. When rates jump, those portfolios suddenly carry massive unrealized losses. This is exactly what happened to Silicon Valley Bank in March 2023. The bank had loaded up on long-term treasuries when rates were low. When rates surged, the value of those bonds collapsed. Once depositors panicked and demanded their money, SVB was forced to sell bonds at a loss to raise cash. Those losses wiped out capital, and the bank failed in less than 2 days. The shock spread. Signature Bank collapsed. First Republic followed. The Federal Reserve had to create emergency lending programs to prevent a wider banking crisis. That disaster came from one mid-sized bank. Now look at what the biggest banks are doing. In its 2025 filings, Goldman Sachs revealed that its U.S. government securities holdings dropped by about 42% year over year, falling from roughly $280 billion to near $160 billion. That's not a small adjustment. It's a major liquidation. Other giants followed. J.P. Morgan reduced its securities portfolio. Bank of America sold tens of billions. Citigroup, Wells Fargo, and Morgan Stanley also cut bond exposure. Across major and regional banks, more than $800 billion in treasuries have been sold. Banks claim this is about regulations and balance sheet management. But here's the key point. Many of these bonds are being sold at a loss. If nothing were wrong, they could simply hold them to maturity. Instead, they are choosing liquidity over yield. Goldman has boosted cash, reduced commercial real estate risk, tightened credit, and cut leverage. These are defensive moves. In a strong economy, banks take risk. When they prepare for trouble, they protect capital. Goldman isn't guessing. They're positioning for instability.
Goldman Sachs has lived through every major financial shock: the dot-com crash, the mortgage meltdown, the European debt crisis, and COVID. They didn't survive by luck. They survived by spotting danger early and positioning ahead of it. So when a firm like Goldman unloads nearly $847 billion in government bonds, it isn't guessing. They're analyzing data most people never see and running models the public doesn't have access to. And those models are warning that U.S. Treasury bonds, the foundation of global finance, are becoming a risky place to hide. To understand why, look at interest rates and the corner the U.S. government is in. As of January 2026, the Federal Reserve's benchmark rate sits around 4.25–4.50%. That's lower than the 2023 peak, but still far above the near-zero world we lived in for over a decade. At the same time, U.S. debt has exploded to about $36.2 trillion. Debt isn't free. It requires interest payments, and higher rates make those costs surge. In 2023, the U.S. paid about $659 billion in interest. In 2024, that jumped to $879 billion, a one-year increase of over 30%. By 2026, projections show interest costs pushing past $1.1 trillion annually. That money doesn't build roads, fund schools, or strengthen defense. It only pays for past borrowing. It's approaching the size of major programs like Social Security and exceeds many core government budgets. Here's the trap. The US government doesn't have $1 trillion in extra cash, so it borrows more. More borrowing raises total debt. Higher debt raises interest. Higher interest forces more borrowing. This is a classic debt spiral. The escape routes are ugly. Slash spending, raise taxes, grow impossibly fast, print money, or default. None are painless. Now add foreign sellers. About $7.6 trillion of US debt is owned overseas. China and Japan, once massive buyers, have been reducing holdings. When foreigners sell and banks cut exposure, the Federal Reserve becomes the buyer of last resort, creating money to absorb the debt. That fuels inflation, forces rate hikes, raises debt costs, and restarts the cycle. It's not politics, it's math, and Goldman Sachs can see where that math is heading.
To understand why this pattern is so dangerous, we have to look back at a moment in history that closely mirrors today. The year is 1979, and the United States is in serious trouble. Inflation is running at nearly 13%. Gas lines stretch for blocks. The economy is stagnant, unemployment is rising, and confidence in the dollar is fading fast. Foreign governments are even asking for gold instead of dollars. President Jimmy Carter goes on national television and speaks about a national crisis of confidence. Into that chaos steps Paul Volcker, who becomes chairman of the Federal Reserve. He makes a decision that changes everything. His goal is simple but brutal: destroy inflation at any cost. Volcker raises interest rates all the way to 20%. It works, but the price is massive. America falls into the worst recession since the Great Depression. Unemployment reaches 10.8%. Thousands of businesses collapse, farmers lose their land, and entire industries suffer. But there's an important difference between then and now. In 1979, total U.S. national debt was about $845 billion, and the debt-to-GDP ratio was near 32%. Today, the debt is over $36 trillion, and the ratio is around 124%. In other words, the debt is more than 40 times larger in absolute terms and 4 times larger relative to the economy. Volcker could raise rates because the government could still afford the interest. Today, that option no longer exists. If the Federal Reserve tried to push rates to 20% now, interest payments alone would exceed $7 trillion per year, more than the entire federal budget. The government would face default or massive money printing, both of which would crush the dollar. That is the trap the system is in. Raise rates and break the government. Keep them low and let inflation destroy the currency. Either way, bondholders lose. History shows us this isn't about if the system breaks, but when. And that moment may be much closer than most people expect.
When bond prices fall, the funds that hold them lose value. That is exactly what happened in 2022 when the Federal Reserve began raising interest rates. The Bloomberg Aggregate Bond Index dropped by 13.01%, making it one of the worst years for bonds in decades. And that happened while rates only moved from 0% to about 5%. Now imagine what could occur if rates rise from 5% to 10%. Bond funds could decline by 30%, 40%, or even 50%. Money people believed was safe could evaporate quickly. The next impact is on jobs. When interest rates surge, businesses that depend on borrowing start to collapse. Commercial real estate is already under pressure from empty office buildings, and higher rates would push it over the edge. Construction projects would freeze, manufacturing would shrink because equipment financing becomes too expensive. Retailers operating on thin margins and credit lines would shut down in large numbers. Unemployment would not rise slowly, it would spike. During the 2008 crisis, unemployment jumped from 4.7% in 2007 to nearly 10% by 2009. A Treasury or bond market crisis would likely be even larger. Then comes inflation. If the government chooses to print money instead of defaulting, prices explode. Not mild inflation, but 10%, 20%, even 30% or more. Paychecks stay the same while groceries, fuel, rent, and basic living costs double. People become poorer without losing their jobs. History shows this pattern clearly, from the United States in the 1970s to Argentina, Turkey, and Venezuela more recently. Finally, the ability to prepare disappears. In a real crisis, capital controls appear, banks limit withdrawals, and transfers get blocked. By the time everyone realizes what is happening, exits are already crowded. Those who move early survive. Those who wait are trapped.
Office buildings across major cities are increasingly empty as remote work becomes permanent. In many markets, property values have already fallen between 30 and 50%. At the same time, nearly $7.6 trillion in commercial real estate loans remain outstanding, and a large share of them will mature in 2026 and 2027. When those loans come due, refinancing will be extremely difficult. The buildings are worth less, interest rates are higher, and lenders are far stricter. The result will be defaults, not small ones, but massive waves of them. When those losses hit bank balance sheets, we risk another Silicon Valley Bank type event, only much larger. Goldman Sachs sees this danger forming, which is why it reduced its commercial real estate exposure by about 29%. They are stepping away before the pressure turns into an avalanche. Now, to be fair, there is another side to this story. Mainstream media and officials argue that banks selling bonds is normal portfolio management. They say firms like Goldman are simply adjusting for regulation. Treasury yields near 4.5%, they claim, are not extreme. In the 1990s, they were higher, and in the 1980s, they exceeded 10%. They also point out that the U.S. economy still looks strong. Unemployment is low, GDP is growing, and corporate profits remain solid. They remind us that people have predicted the collapse of the dollar for decades, and it has not happened. The dollar remains the global reserve currency. Trade, oil, and central bank reserves are still dominated by it, and no true alternative exists. But what this view ignores is how systems actually fail. They don't decline slowly, they break suddenly. Confidence is fragile. It exists until one day it doesn't. Each crisis leaves behind more debt, more leverage, and more money printing. The risks grow quietly until they no longer can. Understanding this matters because preparation is the difference between surviving and reacting too late.
Focus on assets with real, lasting value, not speculation. Choose real estate in areas with strong fundamentals rather than hype-driven markets. Look at productive land, commodities, and resources that hold intrinsic worth and do not rely on government promises. Gold and silver have protected wealth for thousands of years across civilizations. They pay no interest, but they also cannot default. Next, reduce debt. If you carry variable rate loans, consider locking them into fixed rates while conditions still allow it. If you have high interest balances, start paying them down. In a crisis, credit dries up quickly. The people who survive are the ones who do not need to borrow when everyone else is desperate. Third, diversify your income. If all your earnings come from one employer, one industry, or one country, your risk is concentrated. Build skills that transfer across sectors. Develop side businesses. Create multiple streams so that one failure does not destroy your entire financial life. Fourth, stay informed, but do not panic. A crisis rarely follows a neat schedule. It may unfold over months or even years. Acting out of fear can be just as damaging as ignoring warning signs. The smart approach is deliberate, calm, and strategic action. Also understand that the goal is not to become rich from a crash. The real objective is to come through it with your wealth intact, ready to seize opportunities afterward. Wealth is not erased during crises. It is transferred from those who are unprepared to those who saw the shift early. Now, bring this back to the bigger picture. Goldman Sachs sold about $847 billion in U.S. Treasury bonds, not for convenience and not because they needed cash, but because their analysis suggests those bonds are becoming a losing position. They see a government burdened by debt. They see interest costs accelerating. They see foreign demand weakening. They see inflation that cannot easily return to 2% without harming the economy. They see commercial real estate near a breaking point. They see a Federal Reserve trapped, unable to raise rates without triggering a crisis and unable to cut them without reigniting inflation. In short, they see a system that has exhausted its options, one that postponed hard decisions for so long that no easy road remains.
While media headlines talk about resilience and soft landings, institutions with decades of crisis experience are quietly repositioning. You can ignore this and trust everything is under control, or you can watch what the smartest capital is doing and ask a simple question: do they see risks that others don't? History will decide if they are right, but when it does, the chance to act will already be gone. The exits will be crowded and losses locked in. Preparation happens before the storm, not during it.